The other week we talked about Larry Fink, and I'm going to start here. Larry Fink said something the other week. He said he wanted the SEC to rapidly approve the tokenization of bonds and stocks. I want to start with Larry Fink. I just read an op-ed this week which sort of takes this idea of tokenization, I want to call it a step further, just to applies to sort of like private markets. I want to ask you what you think about accredited investors. I want to ask you, what do you think is broken? Why are so many companies staying private so long? Why do we have half as many publicly listed companies today than we do in 1990s? But we're going to baby step into this conversation, which I'm hoping is a good one. And I want to start with the comment that Larry Fink made the other week, which is, I want the SEC, and this is King Larry Fink, I should say, head of BlackRock. I want the SEC to rapidly approve the tokenization of bonds and stocks. I believe you agree with that point of view, and I sort of agree that you've been saying that for a very long time, since you sort of wrapped your mind around tokenization and blockchain technology. This was something that you've been talking about. This is the eventuality of financial assets. Would you say that's true, that you and Larry Fink are kindred spirits when it comes to this issue?
I would say that me and Larry Fink have absolutely nothing in common in the whole goddamn world. But yes, I am in favor of rapid tokenization of stocks and bonds.
Agreed.
But other than that, I couldn't give a rat's ass about Larry Fink. Ever since the time he hung up on me in 2002, I couldn't care less about that guy.
You know what? I'm going to do a segment. We're going to do a Hear Me Out where I just put up some quotes. And I'm going to ask you, half the quotes are going to be quotes from you, half the quotes are going to be from Larry Fink. And I'm not going to tell you who they're from. I'm going to have you guess who said it, Larry Fink or Tom Sosnoff. I'm willing to bet I don't think you get 50% right.
I'd be willing to take
half
your
the
side
shit you
too.
Say could have came out of his mouth or yours.
I don't hate your side, but I don't hate your side, but I'm not fading myself on that. But go ahead.
All right. So the op-ed I read earlier this week, it talked about this idea of not only just tokenizing bonds and stocks. So that sort of feels like an eventuality. We're going to get there. We're going to collapse sort of the settlement times that we currently have. We've gone from, I think, 5 days at one point down to 3, down to 2. And that seems like it's going to get instantaneous at some point once we move everything to blockchain. But the op-ed I read was about moving private companies. It was taking issue with the fact that OpenAI, there's hundreds of billions of dollars of value there that cannot be tapped by retail investors. If you're an accredited investor, which means you have $1 million in net worth, or you have income of $200,000 or more in a year, or you happen to be licensed or part of an institutional firm like a bank or insurance company, in those cases, which is about 20% of the public, you might have access to some of these private placements, things of this nature. But for 80% of the public, they don't have access. So my question, so the op-ed basically posits the idea that we should be utilizing tokenization or crypto technology to tokenize some of these private companies, and we should reform the accredited investor rules to give retail investors more access to private companies. And I was curious, one, what you think about that, but then two, are we solving the right problem? In other words, I understand the idea that so much value is being created in the private markets, but part of me wonders, why is that happening? Why have we created this golden goose that we have in these liquid capital markets? Why have we created sort of this monster where these entrepreneurs don't want to list? They don't want to go through that hassle or the cost, and therefore it's easier for them to stay private until they've reached hundreds of billions of dollars in value, and then they really just want to dump liquidity on the marketplace. So two-part question.
I got your question, Victor, and I think.
All right.
I think. Okay. I'm not picking on you at all, but I think you've taken a very simplistic public view of this, and I'll explain why. And I'm not picking on you, but you've taken the view where you've looked at a couple of these amazing companies and you've said, you know what? It's ridiculous that Victor Jones or Tom Sosnoff or somebody else can't invest in SpaceX or OpenAI or one of these other companies that has a private offering to a bunch of hedge funds and other things like that on a capital raise at some made up number. Let me tell you the first of all, I am fully behind being able to crowdsource and fund. I'm 100% in support of tokenized funding for smaller companies. In fact, we tried to do it ourselves on a launch that we were about to do, but we got shut down by the regulators. So I'm 100% behind it. But let's not make this look like something that it really isn't. You cherry-picked a couple of companies that are massively successful. And the reality is that even private equity firms and venture firms that raise billions and billions of dollars and invest hundreds of billions of dollars every year in these companies, their track record is way more losers than winners.
Sure, it might be 70% losers.
It might be 90% losers.
It might be 90% losers.
And I think what you're not realizing is that when you invest in these startups, because I'm like an angel investor. I invest in lots of startups. And you'll hear like Mark Cuban just did a whole piece on how everything he's done on Shark Tank, he's lost, 50 straight investments. I've lost 40 straight times investing in startups. It is so freaking hard. And the success rate is so minuscule that a few of them succeed and 95, 98, 99, whatever the number is, don't. And the ones that do succeed, you pay up to these astronomical numbers because everybody's trying to put a print on the board above the last print. That's why places like SoftBank, that's why places, hedge funds and prop funds and venture groups, sometimes you'll be like, how did these guys invest at $100 billion valuation when now it's going public like Instacart or like Reddit, whatever it was, at $5 billion? Of course there are situations. I got lucky. I was able to invest in Reddit at $5 billion when they failed at $15 billion on their first offering. Now the stock's like $200 billion, who knows? But the point I'm making is it is complete crap. It's crap to think that, oh man, we missed out on all these great trades, because I don't know what's a good trade. You don't know what's a good trade. The marketplace hasn't determined what's a good trade. And the private marketplace, a lot of times, they just put prints on the board so that they can show, on paper, that their investments on paper went up in value, even though the company's not worth anything like that. But nobody cares because it's not traded in the public marketplace. So thinking that this is something that's really easy, it's not. And the reason that tokenization hasn't been approved yet, and that you can only raise, I believe, and you can check me on this, but I think the maximum, if you do a tokenized offering through Republic or Securitize, right now the max offering on a Reg D is 75 million is the absolute max you can tokenize something. It's only 75 million. And in that case, there's a lot of restrictions on top of that. So the reason for that is because nobody has pulled this off successfully. And because the people that try, like ICOs are scams, and the people that try on the tokenized side, they haven't been successful at raising money, because here's the problem. So if I tokenize something if I raise money tokenized, what exchange am I going to put those tokens on, and where are you going to go get liquidity?
And how do I mark them?
Well, first of all, how do you mark them? Because they're going to trade, they're going to be illiquid on some tokenized exchange that very few people have access to, and there's not going to be a two-sided market or anything like that. So the challenge is, there's a couple of challenges here to what the whole Larry Fink argument. On balance, I'm all in favor of tokenizing everything and letting anybody invest in anything they want. But the system is not mature enough right now. And let's be realistic that 95% of these startups fail. So you can't cherry pick the open AIs of the world that are worth 125 million or billion, or the SpaceXs of the world that are worth 150 billion, and say, wow, everybody should have a chance to invest in this.
And now hold on one second, because that was, I think, Victor's original, and you can correct me, Victor, or at least that was what I heard when you said it. Accredited investor. It's almost like you have to have $25,000 in your account not to have patent day trading rules.
No, I understand.
Be an accredited investor. Maybe there should be.
I hate the term accredited investor.
Okay, maybe there should be a pool where you price it, knowing everyone in it is an accredited investor, and then some portion of that is open to the public. Let the public do whatever they want. Maybe the public wants to put $100 in 10 different things so that one or two of them hit, and maybe they can get a home run.
The whole problem with this is, who is going to manage all this?
Right, that's all the
fraud. You're going to have FTX.
You'd rather have 10 investors with.
You're going to have FTX situations. So you're going to invest $100 alongside Sequoia, who's putting in $100 million.
Yeah.
You know, the challenges,
paperwork, everything else. Yeah,
the challenges of all this stuff. So let's talk about.
But everything is electronic these days. It does seem like you could do a lot of things.
I agree with it, Victor.
Real quick. Okay,
let's talk about the more important question here, which you brought up originally, which is, why are these companies staying private to start with? And the answer is because money is more available to private companies. It's easier to get, and it's easier to price, and you don't have to go through all the audit scrutiny, all the regulatory scrutiny. You don't have to deliver on earnings and everything else. So the reason that companies stay private for as long as they do is they get to set their number. And as long as they have people that are willing to support whatever number it is that they put out there, that's what happened in the whole SPAC world. As long as you had people willing to put up money at some crazy number, they could support that offering. As soon as it went to the public marketplace, everything crashed and burned because it was all bullshit. The problem with taking your company public when you're too early is you face too much public scrutiny in your share price, and it distracts you from what you want to do. It's way easier to have the Sequoias, the TCVs, everybody of the world just invest in you and say, hey, this is our number. We're going with it until you prove me differently, until I have to raise more capital. So the challenge is, because there's so much capital on the sidelines, why do you want to go public? Why torture yourself?
All right. Now, first, let me defend my own reputation, because you started this by just an absolutely unnecessary and brutal takedown. First of all, I knew you wouldn't do the pre-reading, but if you had done the pre-reading, I was quoting directly from the op-ed. So it wasn't me taking a simplistic point of view. I was doing my best to lay out the point of view in the op-ed that I sent you prior to this segment. You clearly didn't know again.
No, you were.
In fairness, it was like an hour and a half.
No,
ago.
Stop. You said it. You were very supportive.
Bro, read the first paragraph of that article that I sent you and tell me what companies they mentioned and at what valuations. I was setting up the article, but the article's premise, it's fine. I'm going to move on to point number 2, which is way more interesting. The second point of why people are, so here's my thing. You just said, who manages it all? How do you get rid of the scams? How do you get all the fly-by-night people who are just coming in to basically soak up excess liquidity and hopefully run off with the spoils? How does this not, if we move in this direction, Tom, and I'm all for it. Part of the article made this argument that we should go away from accredited investing being all around how much money you have. Accredited investing shouldn't be just for rich. You shouldn't have $1 million net worth or $200,000 in income. It should be some sort of, it's like, what's your knowledge? How much knowledge do you have about risk and risk management, the business or institution or sector that you're investing in, or in industry? And I'm kind of for that. But the opposite side says like 90 to 95% of these things are going to fail. And so the accredited investor idea is just, you have money to lose. That's sort of the concept behind it, that you can invest in this stuff. You might not be the wisest person in the street, but the point is, if you get burned, you have assets to lose. You're not going to be out on the street. And so there's some part of me that understands a balance of knowledge, but also a means test. But but I would be in favor of getting rid of the means test altogether to get back to this point of who manages all this. Once retail investors, once everybody can participate in a tokenized private company, does that not just open up, somebody gets burned, we get new legislation for how to manage the private market, and you're just going to turn the private market into something that looks like a public market if you give it enough time. The incentive structure says as long as you are going to lower the bar for participation, then you're just going to create a bigger public market. So why can't we reform the public market instead of going about it this backdoor way to say, you know what, let's just let more people in through the public, in through the back door instead of the front door.
I agree with that. Point. I'm all for that. I think they should reform the public marketplace, and it should include, tokenized offerings as well, because it does make it easier for small investors to participate.
Did you just agree with me, Thomas?
I believe he did.
I did agree with you on that. I am in agreement.
You just shook the foundation.
And you want to know something? He didn't read one thing and agreed with you. You see that? See that? He didn't have to read nothing.
I've been down this path, Victor. I actually have gone all the way to the point of signing a deal to do a tokenized offering and understanding the complexities both on a regulatory level and on a consumer level. And it's not even just the regulatory hurdles. It's also on the consumer side. Investors actually at this point don't want a tokenized offering. That's another challenge. I want it, but a lot of investors don't because of the issue that we just talked about. Once you're in those tokens, how do you get out?
No freaking way. Maybe some old person who's still watching the 5 o'clock news somewhere is like, government, please protect me. But I can tell you, everybody under 35, it's just like, let me do what the hell I want to do with my own money. Tokenize
everybody
and let me make my own choices.
Listen, everybody wants to do whatever they want to do with their own money. I'm all in favor of that as well. But when you find out that what you just bought is going to be sitting on an exchange in Dubai or in Canada and that you have no access to because you can't even open an account that trades on that exchange, you feel differently in 2 seconds. Trust me. It's not as easy as everybody makes it seem.
Let me round this off and bring it I wouldn't be doing myself justice, my soul, if I didn't make this quasi-political. I'm sorry, everybody out there. But there does seem to be this sort of drumbeat for deregulation here in the United States, and I would say in some ways globally. I've had so many different conversations with you. I remember talking to you once about some ridiculous bill that was proposed about shrinkflation, banning this idea of shrinkflation, and you were like sort of in favor of it. Yeah, ban these companies from taking out a few Oreos from your packet. You were totally in favor. But then on the other end, you and Scott and Tony, you guys are on the vanguard of basically trying to get this pattern day trading rule abolished on behalf of retail traders with small accounts. I'm curious, how would Tom Sosnoff describe the need for either additional regulation in financial services or the need for deregulation in financial services? Where does Tom Sosnoff come down on the need for either additional or less regulation within financial services? And if you could, where would you swing the axe if it's in the deregulation? Or I guess if you want more regulation, where would you swing the axe there too?
You're going to go deep in the weeds on this one, Victor, because so I'm an advocate for the consumer because that's the world I live in, is the self-directed investor, the consumer investor. That's all I care about. So the axe for me would swing on anything that that has a negative impact on individual self-directed investors. So it starts with things like pattern day trading, like margins that are too high, like different regulatory bodies that don't make sense so that your money gets segregated, which again doesn't make sense, so that you can't trade certain segregated assets in a single account, whether it be digital assets or something like that. So it's, for me, the axe would swing on everything that is consumer related. I mean, I don't want to get into like every single specific, but right now we are subject to multiple regulatory bodies to trade in a single account, and it is very challenging. And on top of that, each regulatory body has their own crazy rules. And so, yes, I would like to see the regulators work with and collaborate with the firms that deal with individual investors instead of having an adversarial relationship where all they do is fine us. That's where it would start.
Do you see how far he had to tiptoe around the words of "I'm in favor of deregulation"? Do you see how far of a trip he had to take there, Tony, in order to avoid using that phrase?
Listen, I've always been in favor of
if I can go to the gas station and buy a lottery ticket, if the only thing I need when I go into a casino is my goddamn identification, you mean to tell me that I got to pass every goddamn test in the world in order to trade a stock? Give me a break. This is not that complicated.
Who told you had to pass any test to trade a stock?
If I can pick a set of numbers at the gas station, I can do it every day as many times as possible.
Sparky.
And there's no
Nobody makes you take a test. Nobody makes you take a test to trade a stock, an option, or a future. Okay?
They don't make you take a test, but depending on who I am and how much money I have and how much experience I have, that depends at some firms what I get access to trade, which instruments I get access to.
We removed that hurdle 20 years ago.
I'm not talking tasty, of course.
We removed that hurdle 20 years ago. That is not it. The only thing.
Go the other direction. Get rid of the whole accredited thing. Make them take a test.
So the only thing.
The answers will be online.
The only thing we care about, okay, is to make sure that the money, because we have to, is to make sure the money that you deposit is yours.
That's anti-money laundering rules you're talking about.
That's all we care about. So when you say you can't come in and do this and that, that's not true. You can do anything you want, but we just want to make sure that the money's yours.
Hey, listen to me. I've done a lot worse. I've spent a couple $1,000s in a lot worse ways. Okay, you ask my wife, who's checked a few of our credit card statements and found some things that she had to question me about the day or the night after. All right, if I want to go in, the most productive use of my capital in many evenings, okay, is through the platform and putting it to productive use in the marketplace. So just let me do it. More deregulation in financial services. I'll say what Thomas Sosnoff can't bring himself to say.
So you want me to say I think you should be able to trade off your credit card?
No, not what he said.
That sounds like what you're saying.
That's not what he said.
You want to buy Tesla calls on your MasterCard?
No.
Oh, yeah.
Yeah,
let me do it. Let me do it, baby. That impacts the structure of the market, okay? That's different. That impacts everybody. That creates structural problems with the marketplace. But outside of structural issues,
you can do it in certain things like event-based trading and FX and things like that. But that's a different regulatory body. Again, we're talking about all of these different regulatory bodies.
I'm going to do a quick summary of what we learned today. We learned Thomas Sosnoff in general agrees with Larry Fink and that he's in favor generally of deregulation. Everybody, I think we just red-pilled Thomas Sosnoff. My work here is done. Hit the like button, subscribe to the channel if you haven't already. I'll see you next Thursday, gentlemen.